Hello everybody, this is Dr. Nalini. I am an assistant professor in finance from Tyagaraja School of Management, Madurai. This course is all about financial management for beginners. If you are a beginner who is interested to learn financial management, this is the right course for you. This course has 4 modules. First module is all about introduction to financial management, where we'll be discussing about the goals of financial management, scope of financial management, and different forms of business organization. Second module is all about measuring returns. It is extensively about time value of money, and we'll be discussing about future value, present value, and types of different cash flows like lump sum, annuity, uneven, perpetuity, and EMI calculation. All that we'll be discussing in the second module. Third module, it is all about financial markets, institution, and instruments, where we'll be discussing about money market, capital market, primary and secondary market, and different types of issues, financial intermediaries, and the regulatory bodies, and finally valuation. The last module is all about measuring risk. Here we'll be discussing about systematic versus unsystematic risk, SD variance, beta estimation, and capital asset pricing model, as well as Markowitz theory. Financial management, that is nothing about planning, organizing, directing, and controlling the financial activities. It is generally about procurement and utilization of funds, how companies raise money and how companies utilize that money in order to achieve their financial objectives. That is all about financial management. The primary aim of financial management is to maximize the shareholders' value. What do you mean by shareholders' value? Shareholders' value is nothing but the wealth of the shareholders. For instance, an investor is investing ₹1 lakh in a stock, like he bought some 1,000 shares of a company at the rate of ₹100 each. So he has been investing ₹1 lakh in a particular company. Maybe after a year, that 1 lakh has become 1,50,000, meaning his stock price has moved from ₹100 to ₹150. This ₹50 is the gain, and since he has 1,000 shares, his profit is 50,000. This 50,000 is his wealth maximization. Company has added some value to the shareholder. So the main aim of financial management is all about enhancing the shareholder's wealth. As we discussed, the goal, as far as the traditional approach is concerned, the profit maximization was the main aim of financial management, where company was concentrating on enhancing the profitability of the company. But in the modern approach, company is focusing on wealth maximization. Wealth maximization is nothing but enhancing the stock price. Moving on to the scope of financial management. Financial management, it is all about value maximization. So value maximization depends on 3 broad categories. One is that investment decision, second one is financing decision, third one is dividend decision. Now there is a question, can a company enhance the shareholders' wealth without adding value? Yes, it is possible. Company can, enhance the shareholders' wealth without adding value, but that value or the wealth is not sustainable. When a company add value to itself, thereby company is enhancing the shareholders' wealth, that wealth will be sustainable. Meaning company has to undertake some good project, thereby company is adding value to the company, and then that will reflect on the stock price, thereby shareholders' wealth will be maximized. So here the core is value maximization. So value maximization depends on 3 broad categories, that is investment, financing, and dividend decision. As I mentioned, financial management is all about raising and utilizing of money. Here if you look at, financing decision is related to raising of fund, whereas investing decision and dividend decision is related to utilization of fund. Financing decision, you can see capital structure and cost of capital. Capital structure, like what is the mix of that capital, how much debt and how much equity in the capital structure, and what is the cost incurred by the company to raise that capital. These two comes under financing decision. This is all about raising of fund, utilization of fund, that is related to investment decision. Company, of course, company has to invest on long term project. There's nothing but investing on fixed asset or the capital expenditure, and short term investment. This is also known as working capital management. Then the other one is dividend decision, that is also coming under utilization of fund, wherein company decides whether to declare dividend or not to declare dividend. So these three broad categories, are the scope of financial management. Capital budgeting. So this is the first step under the investment decision. Investment decision, as I mentioned, we have capital budgeting and working capital management. Capital budgeting is related to long-term investment. Working capital is related to short-term investment. So capital budgeting, this is the process of making investment decision in fixed asset. It is also known as investment analysis. The main objective of capital budgeting is to find out the profitable capital expenditure. Company capex is hefty investment, so company has to find out the profitable capital expenditure. Say for an example, if company has 3 machines and machine A, B, C, company wanted to decide which machine to buy. So company has to apply all these capital budgeting techniques to identify which one is profitable. So that is identifying the profitable capex. And then replacement of existing fixed asset gives more return than earlier. Like company has to decide whether to go for replacement of existing machine or not, whether to continue the existing machine or to go for replacement. Again, they have to apply this capital budgeting technique to identify whether to continue with the existing machine or go for the new machine. Then to decide a project, to decide whether to select a project or not. At that time also company generally uses this capital budgeting techniques. Features of capital budgeting, generally this capex benefits are spread over several years. Unlike operating expenses, capex generally, that company is going to enjoy that benefit over a period of time. And as I mentioned, here the investment is very hefty, so company has to be very careful before taking a final call related to fixed asset investment. They have to apply all these capital budgeting techniques to decide what to buy. And capex decisions are irreversible. Of course, since it is a hefty investment, company cannot reverse it as and when it requires. And it decides the value of the business. If company undertakes the right fixed asset, then that will certainly add value to the company, because it is a hefty investment. If company chooses the right project, that will certainly add value to the company. And different project categories under capital budgeting. One is that replacement project. As I mentioned, if company wants to replace a machine, like a machine is owned out, now company has to go for replacement. At that time, they generally use capital budgeting technique. Expansion project, when a company is going for expansion, at that time also they use this capital budgeting to identify which is the viable project. And when they introduce some new product or services, at that time also they use this capital budgeting. Mandatory product, for instance, government generally says that companies which are polluting the environment, they'll have to concentrate on renewable energy. Those kind of companies have to invest their money in renewable energy. So it can be solar or wind energy. So say for example, the company has chosen both solar and wind. Now company has to decide whether to choose solar or wind energy. So company has to apply all this capital budgeting techniques to identify which is the more commercially viable energy, whether solar or wind. So at that time, so mandatory project also, companies can use this capital budgeting techniques to decide to take the decision. These are the principles of capital budgeting. One is that decisions are based on cash flows, not on profit. Accounting generally our decisions are based on profit, whereas here in finance the decisions are based on cash flows. Cash flow, generally we say profit is a notion, whereas cash flow is the reality. So here it's true. And if profit is given, you have to convert the profit into cash flow. Based on that, you have to take a call. Then timing of cash flow is crucial. When the cash flow occurs, that is very crucial. It is better to, if the cash flow comes early, it is better. Cash flows are based on opportunity cost, because the cash flows here, all these future cash flows will be converted into the present value. To convert the future value into present value, we need discount rate. That is nothing but the opportunity cost. So if the opportunity cost increases, due to that the present value decreases. I am sure that now it is a bit confusing to understand this time value of money and opportunity cost and all. We'll be discussing that in detail in the second module. Cash flows are analyzed on after tax basis, and last one is that finance cost and sunk cost are ignored, because finance cost will be captured in cost of capital, so that here we will ignore that. These are the capital budgeting techniques. One is a simple payback period. Simple payback says how many years it will take for the company to recoup its initial investment. Simple payback period will not apply the time value of money. There is one more payback called discounted payback period, where we apply time value of money. So I would say discounted payback period is superior than simple payback period. Payback period, it is better to have a shorter payback period, because if the project gives you a shorter payback period, meaning that we are able to recover the initial investment within a short span of time. Third is net present value. This is one of the important capital budgeting technique. This is it says the difference between the present value of cash inflow and outflow. For a good project, this NPV should be positive. Always when a company is going to undertake a project, they will ensure that the NPV is positive, meaning the present value of cash inflows are greater than cash outflows. Then only NPV will be positive. If the cash outflows, present value of cash outflows are greater than present value of cash inflow, then NPV will be negative. In that case, company will not undertake that project. Then next one is internal rate of return. This is in a simpler way. This is the rate of return. So it is better to have a higher internal rate of return. In a technical term, it is called the rate at which net present value will be zero. So it is better to have a higher IRR. Generally, IRR will be compared with the cost and expected rate of return. If IRR is greater than expected rate of return, companies will undertake that project. Then the last one is profitability index. This is the ratio form of net present value. Here we take the present value of cash inflow by present value of cash outflow. If inflows are equal to outflow, then PI will be 1. So it is good to have a project having a PI greater than 1, meaning present value of cash inflows are greater than outflow. If PI less than 1, meaning outflows are greater than inflow. In that case, the project will not be undertaken. So these are the key capital budgeting techniques which helps the company to decide whether to invest in a particular fixed asset or not. Moving on to working capital management. This is the short-term fund requirement, like managing of short-term investments. So working capital is nothing but managing the day-to-day expenses. Company has to meet out some of the day-to-day expenses. That is all about working capital. In other words, it is the excess of current asset over current liabilities. Current asset minus current liability is called net working capital. Generally, working capital should be neither excessive nor inadequate. It means if it is excessive, then it is idle. If it is inadequate, that will certainly hit the business operation. So company has to ensure it is neither excessive nor inadequate. Current asset, as you know that, the asset which can be converted into cash within an operating cycle or within a year are called current asset. There are different asset class like cash, inventory, prepaid expenses, debt are all or the example for current asset. Current liabilities. These are the liabilities which should be paid off within one operating cycle or within a year. Example for current liabilities or payable outstanding expenses and so on. So working capital management is all about managing the current assets and liabilities. Working capital, we have gross and net working capital. Gross working capital means the total of all the current asset. Net working capital is excess of current asset over current liability. Negative working capital. Is a negative working capital always a bad sign? No. Negative working capital, when the company will have a negative working capital, is current liabilities are greater than current asset. Let's say the payables are more. Payables are more, due to that company has a negative working capital. In that case, company is not using its own money, company is leaning on supplier. It is it is good to have a negative working capital, but it should not be for a longer period of time. If it is for a short span of time, it is good that because company is leaning on someone else. So that's all about working capital management. So company has to ensure working capital is neither excessive nor inadequate. So capital budgeting and working capital management, these two are coming under investment decision, long-term and short-term investment decision. Moving on to capital structure. As I mentioned, this is all about raising of money. Company has to decide the capital structure. Debt and equity. How much debt the company should have and how much equity in their capital structure. So this is the combination of debt and equity. If the capital structure is optimal, that will certainly enhance the value of the company. So company has to decide the optimum capital structure. There is no optimum capital structure because it varies according to the company, according to the size, nature of the company. That optimum capital structure varies. So there is no ideal capital structure varies. So every company has to decide which is ideal for them. Here the objectives: maximizing the shareholders. Maximizing the value of the firm. If the company has an optimum capital structure, that will certainly enhance the value of the firm. And minimizing the cost of capital. Cost of capital we are going to discuss in the subsequent slides. This is nothing but the cost incurred by the company to raise its capital. So company has to minimize the cost of capital and enhancing the value of firm. These two are the main aim of capital structure. Here you can look at, there are two pictures. One is low levered company and the one is high levered company. Low levered company has $200 debt and $800 equity, so the debt is less. Whereas highly levered company, equity is only $200 and debt is $800, so that it is highly levered company. So company has to decide the optimum capital structure to enhance the shareholders' value. So scope of financial management. So far we discussed about investment decision, where we discussed about long-term and short-term investment decision. Then we discussed about financing decision. Under financing decision we discussed about the capital structure. In the next session we'll be continuing cost of capital, that is the continuation of financing decision.